German CPI grew 0.1% month-on-month in June, as annual inflation rose 1.8% in June, following 1.5% growth registered the previous month, in line with expectation. On the phone with me now is Dr. Stefan Mütze of Helaba, speaking from Frankfurt. Stefan, firstly, can you please talk us through the current sentiment in the German economy?
Yes, the business climate, the German sentiment is not bad at the moment. If you look to IFO climate, it's over the long year average, and the PMIs increased in the last months. One of a strong pillar at the moment for the German economy is private consumption, because we have increases in tariffs, wage increases about 3%. And the inflation rate will be only 1.5% in the year average, and so we have an increase of real incomes. And employment is increasing. A weaker pillar at the moment is the German export, in particular because the Eurozone and the emerging markets import less German products at the moment.
While joblessness has fallen within Germany, we are hearing reports that thousands of Germans are emigrating elsewhere in Europe, marking a stark U-turn from earlier in the euro area crisis, when people were flocking to Europe's largest economy. Life appears to be good for Germany, but what about German citizens themselves?
Yes, we have in the last 2 years, we have again an increasing population. Before we had a decreasing population. We have now an increasing population because we have a net immigration, a positive net immigration. Before we had a negative net immigration. More people from Spain and Italy and the eastern countries are coming to Germany, and less people are going outside from Germany. And though we have an increasing population, this is a strong sign for the German economy and the German growth.
German bonds have opened higher today as CPI performed within expectations. The ECB rate outlook last week also acted to push German bunds upwards. The IMF's decision to reduce global growth forecasts has boosted demand for safer assets. Do German bunds remain a safe asset?
Yes, I don't see any reason why the German bunds should not be a safe asset in future. We don't expect a strong increase of the interest rates. Now we have a yield of 1.6%. At the end of the year, we expect a yield of 1.7%, and maybe in the end of the first quarter 2014, 2%. I don't see any reason why the bonds shouldn't be a safe haven.
And lastly, the euro is currently edging higher ahead of Fed minutes. How much is German sentiment driving the purchasing power of the euro at present? And with this in mind, what can we expect from the single currency in the near future?
Yes, we see the euro a little bit lower in the near future, because we have a different policy from the Fed and the ECB. The Fed policy will going to be more restrictive, less expensive, and the ECB will make an expensive policy. And so this is one reason why the euro will be lower at the end of the year. At least 1.25 we see the US dollar euro.
Many thanks for your comments, Stefan. I'll be taking a look at those all-important Fed meeting minutes with Gennady Goldberg of TD Securities tomorrow, so do stay tuned to Dukascopy TV.